We will begin momentarily. Welcome to this webinar, Investing with a New Tax Plan, as part of our series regarding the Tax Cuts and Jobs Act. My name is Bill Wendling. Investing with a new tax plan. So what stayed the same? What didn't change with the Tax Cuts and Job Act passed last year? Long-term capital gains are still tied to the same dollar amounts. So if you're a joint filer and you had taxable income going forward of less than $77,200, you have a 0% long-term capital gain rate. As the income gets higher, you move into the 15% bracket. So for a joint filer, that's between $77,201 and $479,000. And then there's a 20% bracket for taxable income above $479,000. If you're a different filer, maybe a single filer, the dollar amounts are different. The net investment income tax, also known as the Affordable Care Tax, is still there. It's a 3.8% tax for single filers over $200,000 and joint filers over $250,000. Also, contribution limits for retirement plans are the same, whether that be a 401k, IRA, HSA, health savings account, and the deductibility for retirement account contributions are the same. So if you have access to a retirement plan through an employer, you may not be able to deduct an IRA contribution, but you still may be able to make one. And if you do not have access to an employer plan, you probably can deduct a retirement account contribution, but that didn't change, so whatever you were doing in the past probably will carry forward. So more importantly, what did change? Well, depending on how you look at it, short-term capital gains are still taxed as ordinary income. That didn't change, but because the ordinary income tax rates are lower, the short-term capital gains tax rates are also going to be lower. One big change from last year is that if you do a Roth conversion in year 2018 or going forward, you cannot reverse those. So once you do a Roth conversion, even if the value of that Roth conversion goes down, you cannot reverse them. You still can reverse a Roth conversion from 2017 up until October 15th. So if you're thinking about doing a Roth conversion, that's important to know. Where you can't reverse, or actually what the IRS calls recharacterize. You cannot do those anymore going forward. The miscellaneous itemized deduction is also repealed. So in the past, if you were itemizing your deductions, tax preparation fees, investment fees, and other fees were deductible. Those are no longer deductible. So thank you for listening to this webinar. I hope you have an opportunity to listen to the other webinars. And if you have any questions, please don't hesitate to reach out. Thank you.